Okay, let's move on to problems now. The following information is provided relating to the acquiring firm Mark Limited and the target firm Mask Limited. The question can be very similar. So please choose the appropriate question because everything looks same here. Even sometimes company name also may be same. So many number of times I've repeated the questions in RTP, MTP as well as in exams. So here and there, some new variety also comes, but mostly this is the one they asked. Mark Limited, Mask Limited, earnings after tax, number of shares outstanding, P ratio required. What is the swap ratio based on current market price? They are very clear. What is the EPS of Mark Limited after acquisition, EPS after merger? What is the expected market price of per share of Mark Limited after acquisition, assuming P ratio of Mark Limited remains unchanged? Determine the market value of the merged firm. Calculate the gain or loss for the shareholder of two independent companies after acquisition. For both the companies, you have to analyze. Okay, let's calculate. Okay, simply let's have in the format. I don't use the word mark mask. I will use the word acquirer. Or if you want to be specific in exam, you can present like this. You write whatever they've given, mark and mask. But discussing mark and mask can confuse everybody. So I will just discuss about acquirer company and target company. You can also do like this in exam. Only first time you write mark means acquirer, mask means target. Then going forward, you keep using the word acquire and target. Institute cannot object to that because that's how legal documents are also framed. You know, in a document, first we say this person is named as first party, and after that, it will be referred as first party only. So that's how we are going to write the exam also. It's accepted, it should be accepted. Okay, so mask and after merger. This is merged entity. Then we'll have merged entity. Standard 3 column. Acquirer, target, merged entity. Whatever they've given, you can write down information. Earnings they've given. Number of shares, P ratio. Okay. Let me just write whatever given. 2000 lakhs. 400 lakhs. 200, 100. Then 10, 5. Okay. Now, what is the first part of the question they asked? Leave some space. You might have to calculate something. What is swap ratio based on market price? Swap ratio based on market price per share, based on market price. Okay, so if you want to calculate based on market price, you need the market price first. And typical formula for market price, for exam purpose, is EPS into P ratio. EPS, expected earnings, into P ratio, the number of times you are getting the profit will give you the market price per share. But in some problem, they might give you dividend discount model, D1 by K minus G you have to do. In some problems, you may have to do like that. But and many more ratios are there, but typically, this is what we are going to apply. Swap ratio based on MPS. So we need market price. For market price, we need EPS. EPS is not available. Let's calculate EPS. How do we calculate earnings by number of shares? 2000 by 200. That is, I think 10 per share. 2000 by 200. You get 10 per share. And here 400 lakhs by 100. You get 4 per share. And how do you get market price per share? You multiply P ratio into EPS. Market price per share is calculated by EPS multiplied by P ratio. So 10 into 10 is 100 and 5 into 4 is 20. And swap ratio formula is whatever the market price of target by acquirer. You can remember it as TAR. TAR. Market price of acquirer, market price of targets by market price of acquirer. Only in one exceptional cases, we reverse the formula, acquirer by target, when the ratio lower the better, like NPA for bank merger problems. So target company market price 20 and acquirer is 100. So swap ratio becomes 0.2 is to 1. That is 0.2 for every 1 share of target company. So what will be the number of shares issued? For every 1 share, 0.2 share. And they have how much? Mass limited 100 lakh shares. 100 lakhs multiplied by 0.2, which means 20 lakhs shares are issued. So effectively, this 100 lakhs will now be replaced by 20 lakhs. So going forward, if you're doing column A plus column B, remember everything is going to be in place of 100 lakhs, we will replace by 20 lakhs. Anyway, so first part of the question is done. What is the EPS after acquisition? EPS after acquisition. Basically, EPS of merged entity. How are we going to calculate EPS of merged entity? I mean, earnings of merged entity. Earnings of merged entity divided by number of shares in merged entity. Number of shares outstanding, number of shares issued, number of shares in merged entity. How much is going to be there? Earnings, no synergy benefit information. So 2000 plus 400. So 2400 is merged entity. 200 plus 20 lakh issued. So it becomes 220. Therefore, 2400 divided by 220 will give you 10.91. 10.91. This is the EPS of the merged entity. What is the expected market price per share? Assuming P ratio remains same. So how do we calculate expected market price per share? MPS of merged entity, EPS multiplied by P ratio. EPS we just calculated now. EPS 10.91 multiplied by P ratio. They said assuming the P ratio remains same. That's our normal assumption. Assuming P ratio remains same, that is into 10, which is 109.10. Okay, next. Determine the market value of merged firm. Market value of merged firm. Okay, here very simple. Number of shares multiplied by market price per share. Number of shares, how much is there? 220. And how many, what is the market price per share? 109.1. That will give you 24,002. Or you can also compute by one more manner. When I multiply P ratio with earnings per share, I got market price per share. But instead of multiplying on a per share earnings, if I apply it on total PAT itself, I get the market value directly. PAT multiplied by P ratio should be market value. Let's calculate that. PAT of the merged entity, total earnings 2,400, multiplied by the P ratio 10, which will give you 24,000. This difference in 2 is because round off. 10.91 is rounded off number. Decimals was there. Otherwise, if you take more decimals, answer will be more closer. It will be accurate. But whichever you write, both are accepted in examination. Okay. So this is for up to fourth part. Calculate the gain or loss shareholders on two independent companies after acquisition. They said gain or loss for shareholders. Have they told on earnings? Have they told on holdings? They just told gain or loss on shareholder. So when they talk about just gain or loss, we always talk about their holdings, because earnings per share, even though you calculate, they may not receive it. Only what they receive is dividend. So what is the real holdings? Real appreciation is their holdings, market price. So when they just ask you gain or loss because of merger, we talk about impact on holdings. Okay. Okay. Gain or loss or impact of merger, I'll say. Impact of merger on shareholders holdings. Impact of merger on shareholders. Nothing specified, so I will take it as holdings. On shareholders of acquirer, on shareholders of target. Okay. We can compute on per share basis, or you can also compute on total basis. First, let me tell you what institute solution they have given. Then let me tell you how you can arrive at the same thing in a different way. Both are accepted. First, let me tell you what our institute has given you a solution. Okay. Now in this case, what is the market value of the merged firm? Market value of the merged firm is 24,002. So acquirer is there, target was there. Together when they came, it became 24,002. Now 24,002 belongs to two types of shareholders, because in the merged entity, acquirer shareholders also there, target shareholders also there. How much is attributable to whom? That depends on their shareholding. So in the merged entity, please observe how many shares are there total in the merged entity. Total 220 lakh shares are there. Out of 220 lakh, how many shares are held by acquirer shares, acquirer companies? That is before merger. That is acquirer company shareholder holds 200. And how much will be acquired? How much is held by the target company? 20 lakhs. So what they tell, when you talk about attributable thing, divide proportionately to their shareholding. So we will do like uh, proportionate shareholding in merged entity. Proportionate shareholding in merged entity. So on acquire also, on target also. So 24,002 multiplied by 200 divided by 220. And on shareholders target, same proportionate shareholding. In merged, they will have only 20 lakh shares. So they will have 24,002 multiplied by 20 by 220. So this is their value in merged entity. Uh, 200 by 220 into 24,002, 21,820. And here I think you get 218. I don't have to repeat same thing is there. Okay, before merger, pre-merger, the value of acquirer, market value of acquirer, and here this is value in merged. And what is the value of target? Before merger, what were their values? Number of shares multiplied by market price. That's all. Before merger. Market price we just calculate. I think. Market price 100. Number of shares 200. So market price 100. Number of shares 200. All these are in lakhs. Okay. So 2,000. Market price multiplied by number of shares. 20,000. Okay, that was 21820 then. Okay, 20,000. Target company, 20 rupees is the market price. Number of shares 20. 20 lakhs. Market price also 20. 20. Okay. 20. That is sorry. The 20 market price before merger is 100 lakhs. So 100 lakhs. 100 lakhs, not 20 lakhs. Yeah, 100 lakhs into 20. Correct. 100 lakhs into 20. 100 lakhs shares were there into 20 rupees. 2,000. Okay. So the difference will be the impact of merger. Gain or loss because of merger. $21,820 minus 2,000, 1,820. 2,182 minus 2,000, 182. 21,820 minus 2,000, 2,182 minus 2,000. Okay. This is what they have given. We can present like this. And if you remember, I told you the concept on computing the impact of merger on per share basis. For acquirer shareholder, how do you calculate? For target company shareholder, how do we calculate? I'm not sure whether you remember that. That also we can arrive. Quickly I'll show you the calculation. How do you calculate for the acquirer? What was the market price before merger? It was 100 rupees minus, what is the market price after merger you got? Benefit we are calculating. After minus before. Merged entity market price is 109.1. 109.1 and before merger market price was 100 rupees. Hope you remember this. Market price after merger 109.1, before merger was 100. So benefit for the acquirer shareholder is 9.1 rupee per share multiplied by how many shares they had, 200. You get the same answer, right? 1920. You can also present like this. Is faster, but I've shown you the institute way of solution also, so that when you look at the institute books, you should not be afraid of it. Okay, now similarly for target company, what do you do? Even though we take 109.1, we don't take market price fully for target. We need equivalent market price. For that, what to be applied? Equivalent market price per share. We need to apply swap ratio of zero point 0.2 and minus their market price was 20 rupees multiplied by number of shares 100. See, will you get the same answer? 109.1 into zero point 0.2 minus 20. 1.82 is per share basis into 100, 182. And that's how we got in these two cases also. So which you present is left to you. But whichever you present, you be clear and apply the right numbers. Okay. But my question is slightly different in this case. In this problem, is there any synergy benefits? No, no synergy benefits. Even without synergy benefits, how come both shareholder earned in their holdings? How come both of them profit? I think one profit, one loss, we understand because no synergy benefit. But even then, both of them are earnings. Both of them got more, not earnings. The value of holdings has increased. How can both gain even without synergy benefits? That is a very interesting element in this problem, or even general in case of mergers. That is because of the valuation uh, technique, valuation game, valuation play, I would say. In the sense, by applying the P ratio technique. What is the P ratio? It was 10 rupee earlier, 5 rupee of this company. What do you mean by that? Mark Limited is worth 1 rupee earning 10 rupees and Mask Limited earnings 1 rupee earth now 5 rupees. Now once this Mask Limited, the target company becomes Mark Limited, what is their profits? Profit they still earn 400 lakhs. But what is its valuation? Earlier, this 1 rupee profit, this 400 lakhs or 1 rupee profit was earning 5 times in its valuation. Now it will earn 10 times just because it's part of new company. Very much true. This is a very interesting, important point in mergers. Because what is essentially P ratio? P ratio represents the confidence level to maintain earnings. Maybe acquirer was a big company. People are paying 10 because they were having more confidence in that company. Now, Mask Limited, a target company, maybe lower confidence company. So P ratio was less. So that's why they're giving only 5 times earnings. But when these people acquired it, automatically the confidence increased. And you say the valuation also increased. I'll tell you numerically also, but before I get the concept logic right. It's like this. A person was having no job. Nobody was giving him girls also. He could not get married. Now he got a job in Infosys. Suddenly the valuation changed now. The person has not become different. His valuation is different because he's part of the bigger group. Whether true or not, right or not, I'm not here to comment. But that is the game. That is the confidence level. That's the perception. Similarly, when the Mask Limited was independent, the perception was, oh, I will give only 5 times for their earnings. When the same earnings acquired by Mark Limited, nobody will know. Now Mark Limited profit only will be shown and we say 10 times. But practically, you know what could happen when the news comes out? The acquires a target company. You're acquiring a lower P ratio company. That means in the confidence in Mark Limited will be dented to an extent. Because we are having confidence in your company that you make profits. Now you acquired a lower P ratio company. That means your P ratio we should come down now. I will not pay 10 times. I will pay only 9 times now. Can happen. But who will make these decisions? Only those who are aware of it. So information is the key. How do you get information? You have to keep watching news. But if you want correct news, you should read annual reports. That's why notes to accounts in FR is important for valuation, for changes, all these kind of things. Business combinations under common control. It will not have any impact because book value acquisition will happen. Anyway, so many things are connected. I just want to give you the idea. But the concept here is the valuation given to the Mask Limited in terms of 5 times. Now the same earnings is given the value of 10 times. That is the difference. Mathematically, I'll tell you now. 400 lakhs was there. It was carrying 5 times. Now 10 times. So what is the differential? 5 times. So 5 times is extra applied on 400. So what is the extra gain? 400 into 5. So extra valuation, and that is 2000. And that's what you see here in our calculation. 1820 plus 182, you get 2002. That round off you ignore, but that is the differential amount. And that's always going to be a part of negotiation also when two companies talk to each other. uh, Mark Limited, when they acquire, Mask Limited, when they're valuing, they say, I will value your company only 5 times. Huh? Mask Limited say, how can you say you are taking over my company? It will be part of your profits. No, you take 10 times. That valuation, negotiation always is a matter of discussion. We don't have any one final answer. Ultimately depends on what is the finalized outcome as per the discussions. And for us, whatever information is given in the question will be the finalized outcome. Okay, hope you got it. Let's go further. Okay, let's come to this one. You have been provided the following financial data of two companies: earnings after taxes, equity share, EPS, P ratio, market price per share. Company Rama Limited is acquiring the company Krishna Limited. Exchanging ratio is based on 1-to-1 basis for company Krishna Limited, 1:1. Exchange ratio is based on market price of the shares of two companies because market price are same 35 35. They said 1:1. Let's do. What will be the EPS subsequent to merger? What is the change in EPS of shareholders of companies of Rama Limited and Krishna Limited? Change in EPS. So they're asking impact on earnings. Determine the market value of the post-merger firm, P ratio, likely to remain same. Ascertain the profits accruing to the shareholders of both the companies. Okay, let's calculate. What is the EPS of subsequent to merger? For that, we need first thing they are asking EPS after merger. For that, we need number of shares issued because we need the number of shares in the merged entity. Swap ratio, they said 1:1. So number of shares issued, uh, how many shares? 4 lakh was there. So 4 lakh into 1:1. So 4 lakh into 1, you get 4 lakh. So merged earnings will be EPS of the merged entity. Earnings of the merged entity, no synergy benefits given. 7 lakh plus 10 lakh. There is nothing for earnings, no synergy benefit, 0. Divided by number of shares. Number of shares existing is 2 lakh. Oh, sorry. Rama Limited acquiring Krishna Limited. Oh, they have given reverse. Rama Limited acquired Krishna Limited. So they have given second column to first column. Just be careful. So it's not 4 lakh. There she should 2 lakh there. Number of shares 2 lakh. Okay. See, small things can happen like this. Anyway, 2 lakh. 2 lakh. So existing is 4 lakh. Issued is 2 lakh. Therefore 6 lakh. So how much you get? 17 lakh divided by 6 lakh. 2.83 per share. Okay. So EPS after merger. What is the change in EPS for both companies of Rama and Krishna? That is impact of merger on earnings. Impact of merger on earnings of shareholders. On EPS, okay. Impact of merger on EPS. So let's do for what was your EPS after merger? Minus EPS before merger. The difference, whatever you get, is the impact, gain or loss. Impact of merger. Okay. For acquirer shareholder, Rama Limited. For acquirer shareholders and target shareholders. Okay. So acquirer shareholders, EPS after merger 2.83 minus EPS before merger. What is their earnings before merger? They only have given 3.5. Therefore, the gain or loss, it's negative you get. Not 3.5, 2.5 for acquirer, 2.5. Sorry, second, 2.5. 2.5. So you'll have the gain positive 0.33. And target company shareholders after merger 2.83 but multiplied by swap ratio into 1 minus before merger was 3.5. So you get minus 0.67. One person's profit happens to be other person's loss because there is no synergy benefits. Earnings, it's always true because P ratio does not apply here. And if you want to verify, you can multiply it by number of shares, though they will be exactly equal. How many shares in acquirer? They had 4 lakh and this is people at 2 lakh. So you can multiply by 4 lakh and you can multiply it by 2 lakh. They will be equal. So, I mean, approximately, round off will be there. So 0.33 lakh, 0.33 into 4 lakh, you get 1,32,000 and 2 lakh into 0.67, 1,34,000. The difference because round off, otherwise those two will be exactly equal. Anyway, so plus 0.33 is the impact for acquirer shareholder and minus 0.67 is for the target shareholder impact. Determine the market value of the post-merger firm. P ratio likely to remain same. Market value of the merged firm. Merged entity. Okay. For that, we need a market price of the merged entity. What is, or you can do PAT method also. That is also fine. Let's do PAT method. Anyway, we know total. Oh, PAT is how much? Uh, okay, 17 lakh into pay ratio you can do, or let's do one thing. Let's go by market price basis. Market price of merged entity multiplied by number of shares. Okay. What is the market price of the merged entity? That depends on the EPS. Earnings per share is 2.83. 2.83. And P ratio, take this one, Rama Limited, 14 times. 2.83 into 14 into number of shares. Number of shares will be 6 lakh. So 2.84 into 2.83 into 14, 39.62 into 6 lakh, 2 crore 37 lakh 72,000. 2 crore 37 lakh 72,000. You can also do PAT, that is 17 lakh into P ratio. Approximately you get 17 lakh into P ratio of 14, you get 2 crore 38 lakh. In fact, that is more accurate. But anyway, that's fine. 2 crore 37 lakh 72,000. Okay. Then last part, ascertain the profits accruing to shareholder of both the companies. We already calculated the impact on EPS. Now when they tell about gain or loss, it obviously means the gain or loss on holdings. It's even more clear in this problem. But even otherwise, when they just ask you whatever the gain or loss because of the merger, you always go for holdings. So impact of merger on holdings. Impact of merger on holdings. You can do proportionately method basis like I told you in the earlier problem, or you can do it in the form of per share basis, both fine. I think per share base faster, let's do that, but you can do proportionately also. Per share then multiplied by number of shares. So for acquirer shareholder, for target shareholder, for acquirer shareholder, we will use market price of merged entity minus market price of acquirer. This is per share basis, then multiplied by number of shares of acquirer. After merger minus before merger. Market price of merged entity is, I think we calculated, I think I did not write, 39.62, right? That was 39.62. Minus acquirer before merger, 35. Other person also 35, also. Very good, 35. Multiplied by number of shares of acquirer. Number of shares acquirer, 4 lakh. $18 lakh 48,000. Okay, target company shareholder, same market price of merged entity will take, but not directly. One small change will do. Market price of merged entity and multiplied by the swap ratio minus market price of target company multiplied by number of shares of target company. Okay, merged entity 39.62 is the market price. Swap ratio is 1 only. Before merger also was 35. Multiplied by number of shares. I think they had 2 lakh. 39.62 minus 35 into 2 lakh. 9,24,000. That's all. Okay, let's go further. Okay, now let us do one more problem relevant for this discussion thing. So come to this problem. Tier Limited, that problem, is considering acquisition of Nishana Limited. So Tier is the acquirer. CFO of Tier Limited is of opinion Nishana Limited will be able to generate operating cash flow after deducting necessary capital expenditure of 10 crore per annum for 5 years. So they are talking about now cash flow. I told you, I think a P ratio may not be applicable here. Cash flow is what they use for basis of valuation. Different base of valuation. One of them is P ratio, one of them is cash flow. The following additional information was not considered in the above estimates. Oh, we have not considered, but it means we should consider it. Office premise of Nishana Limited can be disposed of and staff can be relocated in TS Limited office. Oh, the target company office, disclose it. I mean, dispose it, sell it, and those people take it to your company. Not impacting the operating cash flows of either business. See, that's how you can save expense. Synergy means this only. Two office, why to pay separate rent? Ask them to come to here only, and that rent will be saved. That's what they're telling. Now here, the building itself they can be saved. However, this action will generate immediate capital gain of 20 crores. They get one-time cash flow. Synergy gain of 2 crore per annum, like saving in expenses, is expected to be accrued from proposed acquisition. Nishana Limited has outstanding debenture having market value of 15 crore. It has no other debts. It's also estimated that after 5 years, if necessary, Nishana Limited can also be disposed of for an amount equal to 5 times its operating annual cash flow. If you want, you can continue this business. Otherwise, you can sell this business, sell this company for 5 times its operating cash flow. Calculate the maximum price to be paid for Nishana Limited if cost of capital of Tier Limited is 20%. Maximum price that can be paid is the value of that company. So basically, for Nishana Limited, what the acquirer, the target company Nishana Limited, its valuation we have to calculate. Target company value is the maximum price that you would like to pay. Quite a few adjustments are there. Just read quickly once more. So this problem more like a valuation problem, but concept synergy and all was there. So I have to do at this point in time. Okay. So basically, what we are going to do is value of the target company. Value of target company from the point of view of, not from their point, from your point, from the point of view of acquirer. That will be the maximum amount that can be paid. This is the value you get. Therefore, this is the maximum amount that can be paid. Maximum amount that can be paid. So this problem is not based on the concept of P ratio. This problem is on the basis also valuation. And how many years valuation we have to do? They said this will apply for 5 years. And then after 5 years, if necessary, it can be disposed of. You remember what we used to do? Year 1, year 2, year 3, year 4, year 5, year 6 onwards. Terminal value we used to calculate. Here terminal value not required. They said this it can be sold off for 5 times operating cash flow. So let's make use of it. So we'll have in a columnar format like year 1, 2, 3, 4, 5. 6 onwards we need to calculate but not required after year 5. They can be sold off after year 5. Like a terminal value. You can say terminal cash flow. Terminal cash flow. Terminal value. They said valuation we can compute. Let me do a thing. Let me start from year 0. See, because there's some capital gain of sale of building. So I'll do year 0, year 1, then year 2. Okay. So what will be the operating cash flow? Plus synergy benefits. Why I'm showing this separately? Because synergy benefits will come only when acquisition take place. If you have not taken acquisition of this, for if you compute it by the target company from their point of view, synergy would not have come because they don't know that. They will not be aware of synergy benefits, right? They will calculate from their own point of view. Synergy is always only from the acquirer point of view. If it was the question from target company point of view, they will not be aware of synergy benefits. So it will not be taken into consideration. Synergy benefits is only when acquirer sees it. That is the net cash flow. Then whatever discounting factor, discounted cash flow. What is the discounting factor? At 20%. Discounting factor 20%. Discounted cash flow. Okay. What and all the cash flows given? Let's calculate. Year 0, you will be able to sell the building. Immediate capital gain of 20 crores. You'll be able to sell the building. Operating cash flow 20. Net cash flow 20. Discounting factor will be 1. Okay, discounting factor will fill up later. Otherwise, operating cash flow 10 crore per annum. You get synergy of 2 crores. So 10 crores, synergy of 2. So total 12. Operating cash flow 10, synergy 2. So net every year. Synergy will come every year. But capital gain, sale of building is one time. 10 to 12. 10 to 12. Okay, 1 year I missed it. Okay, sorry. Alignment issue. 10 to 12. 10 to 12. 10 to 12. Okay, 5 years over. After 6th year, after 5th year, it's going to be sold at 5 times. 5 times of what number? It is estimated it can be disposed at 5 times. It should be 6. What should be 6? Oh, now you missed 1 year again. Okay, fine. Okay, sorry. I missed 1 year. Sorry. Let me write once more. 5 years should be there. Correct, correct. That's my mistake. I'll write once more. 10 to 12. 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 Okay. Now I think it's fine. And after year 5, you can sell it at 5 times of operating annual cash flow. Operating annual cash flow, should I take 10 or 12? After 5, if you want to sell, it will be 10 only, not 12. Because again, if you are selling, synergy benefit will not continue to them. Synergy benefits only for the acquirer, not for the target, not for third party. It's only for you because you have that extra benefit only from acquire point of view. So it will be 10 into 5, 50. Net cash flow will be 50. Okay, 50. So discounting factor, uh, we can take 4 decimals. 0.833, or you can take 3 also. First one is 1 today, then 0.833. In fact, you can do year 1 to 5 annuity factor because same amount will come. I'm just showing you calculation. You can do annuity factor also. 0.6944, 0.5787, 0.4822, 0.4823, 0.4019. Can you please tell me what is the last year discounting factor? 0.4019 only. Or if you take 3 decimals, same number. So remember, it's not year 6. Though you are writing after year 5, at the end of year 5, year 6 onwards, terminal value, last 2 cash flows will have same discounting factor. You can take the decimals also. So this is 20, well into 0.833, 9.9996. You can take 2 decimals also. 8.3328, 6.9444, 0.4823 into 12, 5.7876, 4.8228, 20.095. The total 75.98. Okay. Okay. Now this is operating cash flow. So what you got now is value of the firm. Value of firm. You have not adjusted for any cash flow from financing activities and all on this. So it's operating cash flow. Means what? Interest and all would not be considered. Net operating PAT, no PAT. Hope you remember. Net operating profit after tax plus whatever depreciation you would have done. Operating cash flow means it is from firm point of view. EBIT after tax from firm point of view. So value of the firm 75.98. And they said they have some debenture, no other debts. Ignore taxation. Okay, no problem. They're having a debenture having a market value of 15 crores. So minus market value of debt 15 crores. That will give you the value of equity. That's what is the maximum amount of the acquired company that can pay. Value of equity 60.98. 60.98. Okay. Okay, let's go further. Uh, Moving on to the next one. As I told you, most problem will be focused on P ratio only. I'm just trying to pick up the problem otherwise. But most of the problems, exam problems, are oriented towards P ratio based problems. Anyway, come to this one. S Limited wants to acquire No Limited, and the cash flows of S Limited and the merged entity are given below. S Limited, merged entity. So S Limited is the acquirer, No Limit is the target. S Limited, acquirer, and No Limited is the target. Year 1, 2, 3, 4, 5, S Limited, merged entity. Earnings would have witnessed 5% constant growth rate without merger and 6% merger on account of economies of operations after 5 years in each case. So if you apply without merger means that is 5% applicable for S Limited on a standalone basis and 6% merger on account of economies of operations after 5 years in each case. In the sense, the 6% is applicable for merged entity in each case because this both of these rates applicable after 5 years. Hope you're able to understand this paragraph. Why should they give you this paragraph information? Because they were given cash flow information for year 1, year 2, year 3, year 4, year 5. But you know, we need the cash flow till infinity. The company is going to be perpetual in nature. So what do we do normally? After a particular year where growth rate will be stabilized or cash flow will be stabilized. And for that, we need what? We are going to calculate terminal value. To help you calculate terminal value, they are giving you information on terminal cash flow. So what we are going to write? Year 1, year 2, year 3, year 4, year 6 onwards. Then the 5% constant growth rate without merger. Without merger means S Limited on a standalone basis if they were the company alone. With merger on account of economies of operation, so they could get extra 1% return, 6%. So that is applicable for merged entity. The cost of capital 15%. That is basically for required rate of return, discounting rate. Number of shares outstanding in both the companies before merger is same, and the companies agree to an exchange ratio of 0.5 shares of S Limited for each share of No Limited. PV factors for 15% for the year 1 to 5 are given. You are required to compute the value of S Limited before and after merger, value of acquisition, and gain to shareholders of S Limited. Okay. Compute the value of S Limited before and after merger means what? We have cash flows of S Limited before merger in the sense of acquirer alone before merger and merged entities after merger. So we will compute the two types of valuation. Value of S Limited if S Limited only was there and value of merged entity after merger. So basically value before merger and after merger. Format is going to be same. Year cash flow, discounting factor, discounted cash flow. And year will be 1, 2, 3, 4, 5, 6 onwards. And discounting factor, cash flow, discount cash flow. Instead of preparing two separate tables, anyway year is common, discounting factor is common. So why to separate two tables? Let's do it in one table itself. So year, only one column. Cash flow, we will have two columns. One is before, one is after. Then discounting factor will have one column. Discounted cash flow, present value, will have two columns. So let's prepare that. So here cash flow acquirer, only for acquirer, which means this is before merger. And cash flow merged entity means after merger. Discounting factor given required rate of return, cost discounting rates also given, discounting factor also given. Discount cash flow, the present value before merger, discount factor, the present value after merger, merged entity after merger. Just have these columns. Okay, here 1, 2, 3, 4, 5, 6 onwards. Cash flow of the acquirer given, the S Limited standalone basis 175, 200, 320, 340, 350, and 6 onwards we are going to apply the formula of Gordon growth model, constant growth, D0 into 1 plus G by K minus G. So here growth rate applicable 5%, 350 into 1 plus 0.05 divided by K minus G. Cost of capital, required rate of return 15% minus G minus 0.05. That comes to 3675, and this 3675 is what is called as terminal value. And this terminal value is at the end of year 5 or year 6 or year 7. At what end we are calculating this terminal value? This is at what point in time? You are calculating year 6 onwards. Okay. Some of you still having the confusion. Very good. End of year 6. Very good. This is at the end of year 5. When I'm using the cash flow of year 6, I get the value at the beginning of year 6, which means at the end of year 5. And I always told you, there is always 1 year gap between the cash flow and the value. When I use D1, I get P0, D0 into 1 plus G. I'm not sure whether you don't remember that concept or you have not listened to those lectures at all. I'm not sure what is the issue. But if that is one simple thing is difficult for you to apply, I really don't know how complex it is you will be able to manage. Anyways, let's go further. Cash flow at the end of year 6, which is what we are using now. One term less because you invest at the beginning, cash flow will start from the end. Year 6 cash flow you are using, which means the value will be at the beginning of year 6, which is at the end of year 5. And as a shortcut, I told you, 1 term gap between the cash flow when it begins and the value you are calculating. 1 term less. Okay. Same thing for merged entity. 400, 450, 325, 590, 620 they are given. And then growth rate. Here 6%. They said because of economies of scale, now they are able to achieve 6% growth rate if merged entity. And present value is 730. When the terminal value is 730. This is TV5. For more clarity, please write down TV5. Okay. Discounting factor, 3 decimal points. They only have given 0.870756 and so on. And last discounting factor, please be very careful. It's not year 6 discounting factor, year 5 only. Cash flow also year 5 and terminal value also year 5. And as a shortcut, I told you how to remember. Last two cash flows will have same discounting factor. So 0.497, 0.497. Multiply and do the present value. 175 into 0.870. I'm taking 2 decimals. You can just round off as also fine. 152.25. 200 into 0.756. 151.2. 320 into 0.658 to 10.56, 340 into 0.572, 184.48, 350 into 0.497, 173.95, 3675 into 0.497, 1826, total 2708, 09. Approximately you can take, that's fine. Merged entity, 400 into 0.87, 348, 450 into 0.756, 340.2, 525 into 0.658, 345.45, 590 into 0.572, 337.48, 620 into 0.497, 308.14, 7302 into 0.497, 3629.09, total 5308.36. Okay. Okay, first requirement of the problem. You're required to compute the value of S limited and know after, before and after, which you have done. Second, value of acquisition. Value of acquisition means what is the benefit for the acquirer. Very simple calculation. With merger, how much present value they get? 3530.36. Without merger, they get 2708.91. So what is the benefit they get if they do merger? 5308.36 minus 2708.91. And that's what is called as value of acquisition. So the value of merged entity means after merger minus value of acquirer, that is before merger, value of merged entity minus value of acquirer, that is before merger with without. This is the difference. You get 2599.45. This is the value you get. You can also call this as maximum purchase consideration to be paid, because this is a benefit they get. So this is the maximum amount which they can pay as purchase consideration. You can also call that. Value of acquisition is also called as the maximum PC that can be paid, because this is the benefit you get. This is the value you get. So how much price you can pay? Not beyond 2599.95. Because if you pay more, you receive less, but pay more, you end up in a loss. This is the benefit which is received by the acquirer. So value of acquisition for the acquirer 2599.45. If he pays beyond this, the acquirer will lose. So this is the maximum PC that can be paid. Just like maximum exchange ratio, this is the maximum PC that can be paid. Okay, hope you're done till here. Any questions? Okay, next. Gain to shareholder of S Limited. Now, gain to shareholder of X Limited, we could have done two methods. Proportionate basis we can do, or I told you market price after merger minus market price before merger multiplied by number of shares. That method also you could have done. But market price after merger before merger, we don't have information on market price. We don't have information on number of shares. Then we have to do proportionate holding. For proportionate holding also, we don't have information about number of shares, but one data given, one data point given, number of shares not given, market price per share we could not calculate because number of shares not available, but one information given regarding the number of shares. What is that? They said exchange ratio is 0.5 and number of shares outstanding in both the companies before merger is the same. Number of shares of both the companies are same. So how are we going to calculate? So if I say acquirer and if I say target, number of shares, acquirer had one, target also had one, and swap ratio. What is swap ratio? 0.5 for every one share, right? 0.5 is to 1. Swap ratio 0.5 is to 1. 0.5 for every one share. So this one share will be replaced by 0.5. So in the merged entity, what will be the total number of shares on a ratio basis? One share will be held by acquirer shareholder, 0.5 share will be by target shareholder. So total in the merged entity, it will be 1.5. See, if you had 10,000 shares here, 1,000 shares here, what you would have done? 1,000 multiplied by 0.5, this would have become 500. So 10,000 plus 500, you would have called 10,500. But here what we are doing? Acquirer is having one share. Target is also having one share only. They said the same number of shares, equal ratio. So target one share, replace it by the swap ratio given to them 0.5. So one share will be acquirers, 0.5 shares will be target. So in which proportion do you think the acquirer shareholder and target shareholder will be there in the merged entity? In the ratio of 1 is to 0.5. So I can say like let's say 3 is to 1 or something, or 2 is to 1, 2 is to 1, like that. Or directly we'll do 1 divided by 1.5 is the proportionate holding of S Limited. 0.5 by 1.5 is the proportionate holding of a target company shareholder in the merged limited. Okay. So the value of merged entity 5308.36, merged entity proportionate holding is 1 by 1.5 minus 2708. So out of 5308, what belongs to the shareholders after merger? If the settlement is by way of shares, is only 1 by 1.5, which is 3538.31, and before merger was 2708. So differential for the shareholder point of view, it is 830. Okay. Hope it is done. I'll go further. Okay. Let's go further. Okay. Let's move on to this question now. Anki Limited and Shanky Limited. I hope you get the question. Anyway, I'm not seeing any responses, so I'll go assuming that you know it. Hanky Limited and Shanky Limited operate in the same field, manufacturing newly born babies clothes. Although Shanky Limited has an interest in communication equipment, Hanky Limited is planning to take over Shanky Limited. The shareholders of Shanky Limited to not regard this as hostile bid. The following information is available about the two companies. So Hanky Limited and Shanky Limited, current earnings, number of shares, percentage of retained earnings, return on new investment, return required by equity shareholders. So percentage of retained earnings means retention ratio. Normally in formula we used to call it as B. Return on new investment is like R in formula we used to use, or ROE or ROA, return on assets, and return required by equity shareholders. That is what is called as KE, cost of equity. I think by now you should be able to think what they're trying to hint, what method they're trying to ask you to apply. I hope you're able to get it. Because where we require growth rate, where we require retention ratio, required rate of return K, G, dividends, retention ratio. So it will be based on dividend growth model. That is the hint. Anyway, let's read further. Now they just started. You see, dividend just have been paid. So they're talking about dividend based valuation here. And retainings have already been reinvested in new projects. Anki Limited plans to adopt a policy of retaining 35% of the earnings after takeover. So this 35% will be the after merger retention ratio. After merger retention ratio, the B. The retention ratio B, normally we give notation as B, after merger, 35%. And expects to have 17% return on new investment. So after merger, again, new R, new retention ratio, new return on investment. Saving due to economies of scale are expected to be 85 lakh per annum. Synergy benefits. Saving due to economies of scale, synergy benefits. Required rate of return to equity shareholders fall to 20% to portfolio effects. This is new cost of capital, new KE, new cost of capital. Calculate the existing share price of Hanky Limited and Shanky Limited. Find the value of Hanky Limited after the takeover. Advise the Hanky Limited on the maximum amount it should pay for the Shanky Limited. Maximum amount means I told you the maximum PC that can be paid, value of acquisition. That will be the amount that can be paid. Anyway, calculate the existing share prices. You know, we can't compute existing share prices. It's a market determined force. Back to basics. I'm sure you will not remember this. Back to day one discussion. Value versus price. Value means the value received by the individual and differs from person to person, case to case basis, subjective in nature. Whereas price is always decided by market forces, supply and demand. Nobody can compute price. Price is always determined by markets. But in the exam, whenever they say compute market price, we can't tell the market price cannot be computed. Your question is wrong. We can't tell like that. So what do we tell? We compute the value. So we compute the value and we assume value and price are equal. So that value is called as theoretical price, equilibrium price, P0, value per share, intrinsic value, different name, different people will provide. So in this case, based on the information given, so we have to calculate the value based on dividend based calculation because dividend based informations are available. So let's calculate for both the companies the market prices. Hanky Limited, Shanky Limited. Okay. That is the acquirer targets, acquirer targets, and if required, you can have one merged entity. No information, but if required, we'll have it. I think we have merged entity. We can have one more call. Okay. So acquirer targets, merged entity. Since we are doing dividend based valuation, let me quickly write the formula for that. P0 equals D1 or D0 into 1 plus G by KE minus G. So what are the information we require? First, we require dividend. Let's see what information we have regarding dividends for the two companies separately. We have current earnings and percentage of retained earnings. So we will be able to calculate dividends. Okay, now this is the current earnings. So if I calculate current earnings based, I get D0. Acquire a target I'll do, then I'll come to merged entity because one discussion should happen for merged entity. For acquirer, current earnings is 650 lakhs and retained earning is 20%. Means retention ratio is to B is 20%. If retention ratio is 20%, how much will be payout ratio? Remaining 80%. In the sense, 1 minus retention ratio is payout ratio. So I'll do 6.6 lakh, 6.5 crores into 1 minus 0.2. 6.5 crores, 6 crores 50 lakh multiplied by 1 minus 0.2. 1 minus retention ratio. 1 minus B is payout ratio. 650 into 0.8. 5 crore 20 lakh. Similarly, for target company, 240 lakhs into retention ratio is 80%. So payout ratio 20%. 2 crore 40 lakh into 1 minus retention ratio is payout ratio, 1 minus B. 19 lakh 20,000. 1 crore 92 lakhs. One minus 0.8, sorry, 1 minus 0.8, correct. You multiply it by 0.2, you get 48 lakhs. One minus 0.8, 20% payout ratio. Okay, so D0 we got it. Let's calculate then G, growth rate we require. Growth rate, which is calculated by B into R. Retention ratio, in this case is 0.2 multiplied by return on new investment, 15%, 15, both 15, 15. 0.15, here 0.8 into 0.15. So I think here you get 0.03 or 3% or 0.3, yeah, 0.03 or 3%. Here you get 0.20, 0.12, sorry, 0.12 or 12%. Okay. Then value of company or value of equity. D0, which is 520 lakhs, 5 crore 20 lakhs into 1 plus growth rate, 1 plus 0.03 divided by K minus G. Cost of equity 21%. 0.21 minus growth rate 0.03. Similarly here 48 lakhs into 1 plus growth rate 0.12 divided by K minus G, and here K is 24%. 0.24 minus growth rate 0.12. ₹29 crores 70,000, 20 crores 75 lakhs 55,556. Here 48 lakhs into 1.12 divided by 0.12, 4 crore 48 lakh. Okay, but they're asking value per share, so divide by number of shares. $50 lakh and 15 lakh. Divide by 50 lakh and divide by 15 lakh. So you get value per share. That's what we'll call it as P0, the current market price according to that. 2975, 55,556 divided by 50 lakh. 59.51. 29.87. Okay. Merged entity, I don't have space here, so I'll write in the next page. Or we can see, no, I'll write in the next page. For merged entity, if you have space, you can write. I'm just writing the last column so you understand. Merged entity. I'm writing the last column. I don't have space here, so I'm writing the next page. But you can fill it up there itself correspondingly. Okay. Now, merged entity earnings will be how much? 650 lakh and 24 lakh. Plus synergy benefits also you get. And also, growth rate will be new. The discounting rate also will be new. And return on investment also will be new. So we have to reapply B into R. We get new growth rate. So new growth rate will be new growth rate. B into R. Revised one. Retention ratio. Entity will have the policy. The merged entity will have the policy of retaining 35% and return on new investment 17%. So B into R 0.35 new retained earnings into new rate 0.17 equals 0.35 into 0.17 0.0595 or 5.95%. Okay, but in this context, one important information we have to understand. Okay, dividend have just been paid. That's perfectly fine. The retained earnings have already been reinvested in new projects, which means for the first year, the growth rate will not be 5.95%. The cash flow of the merged entity for the first year cannot be 5.95%. That applies only from year 2 onwards for the first year. So we are calculating D1. For calculating D1, I cannot use the growth rate of 5.95 because retained earnings have already been reinvested. So that investment income will be growing at what rate? Since the retained earnings are already reinvested by the two companies respectively, how much reinvested? They have reinvested 20% here and 80% here, and they will generate 15%, 15% respectively. In the sense, they will get the income in their growth rate for the first year. So to calculate D1, we need earnings of the first year. Earnings at the end of the first year are not calculated by sum of the earning into 1.0595. 5.95 growth rate will not be applied because for the first year, 5.95 will not be realized. Why not realized? Because Hanky Limited has already invested. Shanky Limited has already invested, so their earnings will grow at their growth rate for the first year, and that you receive after first year. You get earnings after first year. On that, you apply dividend payout ratio. You get the dividend at the end of first year. Let's write that. Since retained earnings are already invested, retained earnings are already invested by acquirer and target company, earnings of the first year will grow at earnings of the first year will grow at respective rates. will grow at respective rates, respective growth rates, respective growth rates. Okay, so we had the acquirer, we have the merged entity, acquirer, targets, and merged entity. Okay, so what is the retained earnings? What is their earnings, current earnings? Current earnings, 650 lakh and 240 lakh. 650 lakhs and 240 lakhs. And they are growing at what rate? They are reinvested. How much retained earnings? Uh, this is current earnings, but retained earnings? Reinvestment, retained earnings, which are reinvested, 20% and 80%. So into 20% into 80%. One crore 30 lakhs. One crore 92 lakhs. Okay, retained earnings reinvested. And this will generate how much income? So income from above investment. How much they generate return? Return on new investment? 15%, 15%. On this 15%, 15%. 1 crore 30 lakhs into 0.15. 19 lakh 50,000 and 192 into 0.15. 28 lakh 80,000. Okay, now this is income from the new investment. And they were already earning incomes of how much? 650 lakh and 240 lakhs. They were earning from existing investment, from earlier investments. This, what they got from the new investment, is additional income, is the growth. So what is going to be their total income at the end of the year? Income at the end of the year. $650 lakh. Anyway, they were getting income, and new additional income you get now 19 lakh 50,000. So 650 lakh plus 19 lakh 50,000. Six 69, 6 crore 69, 50,000. 6 crores 69, 50,000. But I showed you detailed calculation. You don't have to show like this, because effectively this 20%, 15% is growth rate. Growth rate we calculated to be how much? 3%. So 650 lakh is existing earnings anyway. On 650 lakhs, you add 3% growth rate, you get the same number. 650 lakhs into 1.03, you get the same answer. I just showed you detailed calculation how that growth rate is achieved. 650 lakh is your existing income that anyway will come, whether you reinvest or you don't reinvest, whether you pay dividend or don't repay. That 650 lakh is current income from current investments that will continue for sure. In addition to that, how much you get, that depends on how much you reinvest. And how much you're investing? You're investing 130 lakhs. And that 130 lakhs is giving you 15% return, which means additional income you're generating in addition to your existing income is 19 lakh 50,000. So 650 lakh anyway you are getting, 19 lakh 50,000 you additionally you get, total 6 lakh 6 crore 69 lakh 50,000. And effectively that is nothing but if you really want to just compare, 650 lakhs multiplied by 1 plus growth rate, you can simply multiply it by 1.03, you get the answer. Because growth rate, how growth rate you calculated? This 20% you multiplied by 15%. That is 3%. And that's what effectively 3% growth rate, 615 to 1.03, you get the same answer. Okay, hope you got it. Similarly, we'll calculate here for the target company, 24 lakh anyway you're getting. Now additionally you get 28 lakh 80,000 because of new investment. So 24 lakh, 2 crore 40 lakhs, 240 lakhs plus 28 lakh 80,000 2 crores 68 lakh 80,000. And here also effectively you can verify. You can effectively verify because what is the growth rate of target company? We did 80% into 15%, we got 12%. So from 240 lakhs to 240 lakhs, you multiplied by 1.12, 1 plus growth rate, 1.12, effectively you get 2 crore 68 lakh 80,000 only. So directly you could have calculated. So merged entity, apart from the 6 crore 69 lakh 50,000 plus 2 crore 68 lakh 80,000 plus one more they get for the merged entity. What they get one more at the end of the year is their economies of scale, which is synergy benefits, 85 lakh. 85 lakh. So 6 crore 69 lakh 50,000 plus 2 crore 68 lakh 80,000 plus 85 lakh. 10 crore 23 lakh 30,000. This is the merged entities income. But we don't need income, we need dividend. So it is at the end of the year, so D1. Ten crore 23 lakh 30,000 multiplied by new retention policy, new growth dividend payout ratio. Retention policy 35%. So payout ratio 1 minus of that. 1 minus 0.35. Six crore 65 lakh 14,500. Okay, this is D1. Then compute P0 value. P0. This you don't do 1 plus G. This is D1. So D1 by K minus G. D1 by K minus G. So 6 crores 65 lakh 14,500 divided by K minus G. Cost of capital also new cost of capital. 20%. New cost of capital 20%. 0.2. minus G. Growth rate, new growth rate 5.95. 0.0595. 47.34, 12, 811. 47.34, 12, 811. The value of merged entity. 47.34, 12, 811. Value of merged entity. Value of merged entity. Okay, hope you got it. I showed you so many calculations, but let me tell you, in the exam you don't have to show so much calculations. For conceptual purpose, I told you exam how we can present straightforward. You can do it in one line calculation for the merged entity. Directly you can do calculation, that is V0, value of merged entity, can be calculated by formula D1 by K minus G, basic formula. And how do you calculate D1 directly? Earnings of acquirer was 650 lakh, and this is growing at how much? 3%. So 1.03 plus earnings of target is 240 lakhs multiplied by their growth rate is 12%. So 1.12 plus economies of scale, synergy benefits 80 lakhs. And whole of this will give you the earnings of the entity. This is the earnings of the entity. Whole of this you can multiply it by the payout ratio 65%, because 1 minus 0.35, 35% retention ratio, 1 minus 0.35 divided by K minus G. K is 0.2 minus growth rate 0.0595, new growth rate. One line you get the answer, you can verify. Use the M plus MRC function. Okay. Oh, 85 is the Synergy benefits, not 80, 85, right? Synergy benefits 85, sorry, 85. Synergy benefit is 85. I took 80. 85. Okay. Forty-seven, 34, 12, 8, 11. Okay. This is the value of merged entity. And again, you can mention it. We took the old growth rate because it's already invested. We took the old growth rates because already invested. Had they not told already invested, I would take the new growth rate. That is for 650 lakh also, for 240 lakhs also, I would have applied together 5.95 new growth rate I would have applied. Or earnings into dividend into 1 plus G, new growth rate I would have applied. But here, because it's already invested, I have applied the old growth rates. Okay. Next. Advise Sankey Limited on the maximum amount it should pay for Sankey Limited. Maximum amount, maximum purchase consideration. Maximum amount that can be paid. Maximum amount that can be paid is value of merged entity minus value of acquirer entity. Basically, after merger minus before merger. After merger value minus before merger value. Okay, so value of merged entity, we just got it now. 47, 34, 12,811 minus value of the acquirer is 2975, 55, 56. 2975, 55 by 56. So with merger, without merger, what is the difference? That's the maximum amount if they're paying out. The if they pay more, they lose. If they pay less, they get it. So this is like a cutoff point, like a break-even point. You can say maximum value, maximum PC. So 2975, 556, 4704. No, sorry. 4734, 12811 minus 2975, 55, 556. 1758, 57. 1758, 57, 255. 255. This is the maximum amount that can be paid as purchase consideration. Value of with merger, without merger. Value of acquisition. It's also called as the value of acquisition for acquirer. Not for shareholder, for the acquirer. Value of acquisition for shareholder. For acquirer, not for shareholder, for acquirer. For acquirer. If you want to calculate for shareholder, the proportionate shareholding will come. The merged entity value, proportionate shareholding minus pre-merger value difference, that's for shareholder. But value of acquirer for a company as a whole, it will be with merger minus without merger, the difference. Okay, let's go further. Okay, let's go further. Abhiman Limited is a subsidiary of Janam Limited, is acquiring Swabhiman Limited, which is also a subsidiary of Janam Limited. The following information is given. Abhiman, Swabhiman, percentage of shareholding, share capital, free reserves and surplus, paid up value per share, free float market capitalization P ratio. Free float market cap means what? Market value, market cap held by non-promoters, held by public. That's why it's called as free float, available for trading purpose. Promoters will not trade, they do business. Therefore, free float means value of shares, number of shares held by non-promoters, held by public, multiplied by market price per share. Janam Limited is interested in doing justice to both the companies. The following parameters have been assigned by the board of Janam Limited for determining the swap ratio. Book value 25%, earning per share 50%, market price 25%. Oh, we have to calculate based on all the three swap ratio, then take a weighted average, not one swap ratio, three swap ratio, then take average and weighted average based on the weights given. You're required to calculate swap ratio. Book value, earning per share, expected return, expected price of Abhiman, assuming P ratio of Abhiman, the acquirer, remains same, and all the assets and liabilities of Swabhiman are taken over at book value. Okay, so we need to compute swap ratio based on book value, based on earning per share, based on market price. We need three things first. Then we can take the average of it. Okay, let's do a columnar format. Acquirer, target. If you want one merged entity. Okay, first we need book value per share. For book value, we need net worth. But for net worth, we don't have information about assets minus liabilities. No problem, sir. We can do share capital plus reserves and surplus. We know share capital, we know reserves and surplus. Together we can calculate net worth. Shareholders funds, net worth. Share capital plus reserves and surplus. And one more point, keep it in mind, whether free reserves or not does not matter. Because when you say company, all reserves, whether free reserve, statutory reserve does not matter. We are not looking at any legal restriction here. Everything will be part of net assets. Okay. Share capital 200 lakhs, free reserves 900 lakhs. 200 plus 900. So 1100 lakhs. And targets 100 and 600s. So 700 lakhs. Merge will come to it later. Divide by number of shares. How many number of shares? Oh, number of shares not given. But we can calculate. How we can calculate? We know the share capital 200 lakhs and we know paid up value is 100. So 200 by 100 means 2 lakhs. So divide by 2 lakhs and divided here 100 lakhs by 10. 100 lakh paid up value, share capital 10 rupee per share. So number of shares will be how much? 100 lakhs by 10 means 10 lakhs. So what is the value per share? Comes to 1100 divided by 2, 550 rupees per share. Not lakhs, both lakhs got cancelled now. 550 per share, book value per share. Then 700 divided by 10, 70 per share. Book value per share. Okay, one is done. Now, coming to second part. We need earnings per share. For earnings per share, have they given earnings? Not given. Had they given earnings, I would have divided by number of shares. I would have got EPS. Not given. Then what do you think we can do? We don't have earnings to divide by number of shares. Number of shares we have. Earnings we don't have. Then we'll take the help of P ratio. Market price per share divided by P ratio will give you EPS. Sir, market price per share also not available. Sir, market value given. Where market value given? Market value given, not full, only free float market. Which means this 500 lakhs is the shareholding by non-promoters. Promoters 50%, balance promoters, non-promoters 50%. Similarly, 150 lakhs, 156 lakhs, free float market cap of Swabhiman is public. How much public? 60% is by promoter. Public will be by balance 40%. So let's calculate those things now. The public holding or non-promoter holding. %50, that is 1 minus 0.5, which is 0.5 percentage I'm telling, and here 1 minus 0.4, 0.4 or 0.6, 0.6 sir. 1 minus 0.6, which is 0.4. And free float market cap they were given. Uh, 500 lakhs, 156 lakhs. 500 lakhs, 156 lakhs. Okay, so how many shares held by non-public, non-promoter, public? Number of shares. So free float market cap is the market value held by public. So divide by number of shares by non-promoters. By non-promoters. How much is going to be non-promoters? Number of shares 2 lakh, 50.5. So 2 lakh into 0.5 if I do, 2 lakh into 0.5 if I do, I get 1 lakh. And here 10 lakhs shares multiplied by non-promoter 0.4. So 10 lakh into 0.4, 4 lakh shares. So what will be the market price per share, MPS, market price per share? 500 lakhs is the value of the shares held by non-promoters. 1 lakh is the number of shares held by non-promoters. So 500 lakh by 1 lakh, that comes to 500. And second case, number of value of free float market cap is 156 lakhs divided by number of shares held by public, held by non-promoters, 4 lakh, and that gives you 39. Since we got the market price per share, now we can get EPS divided by P ratio, market price divided by P ratio. P ratio is 10 and 4. That will give you EPS. EPS can be achieved in two methods: earnings by number of shares, if not available, MPS by P ratio. So 500 by 10 will give you 50 rupees, and 39 by 4, 9.75. 9.75. Okay, so we got the three things. We got book value per share 550.70. We got earnings per share 59.75. We got market price per share also 539. So now we can calculate the swap ratio by computing all the three methods and then a weighted average of all the three. Hope you have taken down till here. I'll go further. Okay, so swap ratio calculation. Based on market based on book value per share, market price per share, okay, earnings per share, market price per share. Whatever the ratio we get, and then the weight they have given, and then the product let's get. The weighted average. Or you can do in one line also, it's also fine. And ratio, remember, the formula is going to be target divided by acquirer. TA, that's the shortcut I told to remember. TA, target by acquirer. And because all the three are higher the better. Book value per share higher the better. Earnings per share higher the better. Market price higher the better. So we don't do any inverse calculation. Only in bank merger, NPA, debt equity ratio cases, we'll reverse the formula. Otherwise, target by acquirer. So book value per share, target is 70, 70 by 550. You can keep it decimal or you can keep the ratio as it is. That's both are fine. EPS 9.75 by 50. And MPS 39 by 500. You can keep it as it is or you can keep it decimals. Both are fine. Okay, let me just keep 4 decimals. Or let me just keep it as it is. No problem. One extra step will be there. Weights for book value per share, weights are 25, EPS 50, 25. Weights are 0.25, EPS 0.5, market price 0.25. I think that is the weights given. Yeah. Multiply, you get the products. 70 by 550 into 0.25, 0.0318. 9.75 by 50 into 0.5, 0.0975. 39 by 500 into 0.25, 0.0195. Point 0.1488. So swap ratio is 0.1488 is to 1. For every 1 share, you will issue 0.1488 shares. You can take more decimals also, that's also fine. And always convert, whenever you compute swap ratio, you compute one next line. What is that? Number of shares to be issued. Number of shares to be issued. Number of shares to be issued. So how many shares were there? Number of shares, target company are 10 lakhs. So 10 lakhs multiplied by 0.1488. 1,48,800. 1,48,800 shares to be issued. First part of the problem we have done. Second part of the problem, they want merged entity. After merger, what you're going to get? Book value, market price, EPS. Assuming they said everything remains same. Okay, so we'll make use of the last column here, merged entity. What will be the merged entity? Book value will be, net worth was 1,100 and here was 700. So here it will be 1,800 lakhs. 1,800 lakhs. And number of shares, 2 lakh plus issue, not 10 lakh, 1,48,800. 2 lakh plus 1,48,800. That comes to 3,48,800. So let's calculate here for merged entity. book value per share. Then they want earnings per share. Then they want market price per share. Okay. So book value per share, we just calculated the net worth of the combined entity, 1800 lakhs. Divided by number of shares, we just calculate 3,48,800. 2,800 lakhs. $516.06. Then EPS. EPS, let's do earning, no synergy benefit information. So earnings, oh, we don't have earnings. Okay, they have given EPS. Let's multiply by number of shares, you get their earnings. Okay, so 50, I'll just write it here. 50 multiplied by number of shares. So what is the earning? You also please write down. I'll write in different color here. Earnings of the two entities. 50 multiplied by 2, that will give you 100 lakhs. EPS multiplied by number of shares. And here 9.75 multiplied by 10. EPS into number of shares will give you total PAT. 9.75 into 10, 97.5 lakhs. 97.5 lakhs. So merged entity will be 100 plus 97.5. Total will be 197.5 lakhs. 197.5 lakhs. 197 lakh, 1 crore 97 lakh 50,000 divided by 348,800. 197.50 divided by 348,800, 56.63. 56.62. Okay, 62263. 56.63. Okay, 622. Sorry, 622. So 62. 622. So 62. Okay. Then they said P ratio remains same. What is the P ratio of the acquirer? P ratio of the acquirer was 10. They said that remains same. So market price can be calculated by earnings per share of the merged entity multiplied by the P ratio. So market price per share is calculated by 56.62 multiplied by 10 rupees. EPS multiplied by P ratio. P ratio assuming to be same. EPS into P ratio gives you market price, which is 566.2. So book value per share, market price, EPS. These were the three things which were taken previously for the to calculate swap ratio. Now those three terms are calculated after merger. Okay, this is one typical problem which has come in the exam, not very frequently, but it has come quite a few times. It has come. Okay. Okay, so this is one interesting problem. Please come to this problem. ABC, a large business house, is planning to sell wholly owned subsidiary KLM. Another large business entity, XYZ, has expressed its interest in making a bid for KLM. XYZ expects that after acquisition, an annual earning will increase by 10%. What do you understand by this? After acquisition, annual earning will increase by 10%. This is nothing but synergy benefits. After acquisition, you will have an increase by 10%. That means your whatever annual amount is there, it will increase by 10%. Instead of giving amount in rupees or giving in percentage, if you apply it on the profits, you will get the amount in rupees. Following information ignoring any potential synergy benefits, ignoring this 10% arising out of possible acquisitions are available. Profit after tax, KLM, for the financial year which has just ended is estimated to be rupees 10 crores. KLM's after tax profit has an increasing trend of 7% each year growth rate. And the same is expected to continue. Estimated post-tax market return 10% and risk-free rate is 4%. These rates are expected to continue. Corporate tax rate 30%. XYZ, ABC, proxy entity, number of shares, current share price, dividend payout, debt equity ratio, market values, P ratio, equity beta. Assuming gearing level of KLM to be same as ABC and debt beta of 0, you're required to calculate appropriate cost of equity for KLM based on the data available for proxy entity, a range of values for KLM both before and after synergy benefits to the XYZ Limited of acquisition. Quite a good problem. Many concepts are there in this one. Okay. Let's see who is acquiring whom. ABC is planning to acquire. So ABC is the acquiring entity, or let's say buying entity. No, is planning to sell. Sorry, ABC is not a acquirer, it's the seller. Its own subsidiary KLM. Okay, what is being sold is KLM. KLM is the entity which is being sold. And who is going to acquire? XYZ has expressed its interest. So XYZ is the acquirer. And what is being transferred is KLM. So ABC is the holding company. So KLM is actually the target company which is being sold. And XYZ is the acquirer which I mentioned. So everything we need valuations which is acquired is KLM. So KLM's profit after tax and all they've given. Okay, what we require is KLM's cost of equity. What they're asking? Appropriate cost of equity for KLM. For KLM, what is the appropriate cost of equity? And you know formula for cost of equity, how do we calculate? It is RF plus RM minus RF into beta. Do we have those information? RM, market return available. RF, risk-free rate available. Beta, not available. Beta need to be calculated. Beta not available. Beta of KLM have they given? Have they given beta of XYZ? And beta of ABC, and beta of proxy entity for KLM. For KLM, they have not given. Everything else they have given. And quick recap, equity beta means, do you remember equity beta means levered beta or unlevered beta? So many people just think that equity means unlevered. No, equity means levered beta. Equity means after considering the impact of debt for equity shareholders. Therefore, it is levered beta. And what we require is also levered beta as per CAPM. But what we require for KLM, that is not given. Okay. Now, beta comprises of two types of risk, as you know. Or risk will comprise of two types. Levered beta will comprise of two risks. One is called as the operating risk. And the other is called as the financing risk. Risk of business, risk of debt. Now, beta of, levered beta of the KLM what we are calculating, what is their nature? Their business will be similar to the proxy entity business. In the sense, the proxy entity means what? They're in the same line of business. Proxy entity in the same line of business. So their unlevered beta, their operating risk, their business risk is same as proxy entity. So operating risk is same as proxy entity. Same as proxy entity. But financial risk, what they told regarding financial risk, assuming gearing level means what? Debt amount, loan amount is same as ABC, because you are under the holding company ABC, you will follow their rules and restrictions. So ABC told my rule only will be applicable on you. That is ABC, debt equity ratio will be same. So financial risk is same as its holding company ABC. So we wanted the cost of equity for KLM, which required equity beta of KLM, and equity beta requires two risks. One is financial risk, other is operating risk. The best part is that beta not directly given. We need to calculate. How are we going to calculate? They said the business of the X proxy entity KLM both are same. That means their operating leverage, operating risk is same, and the debt equity ratio, the gearing level of KLM and ABC both are same. It's holding company, so their financial risk is same. So we have to use the concept of levered beta, unlevered beta correctly to arrive at the beta required for KLM. Let me tell you how the process will begin. Okay, so this is the process you're going to do. Ultimate target is we need levered beta of KLM. That's what we are going to have. We will start with levered beta of proxy entity. Levered beta of proxy entity. But what is the problem with levered beta of proxy entity? Why can't I use the same beta? Sir, proxy entity KLM, why can't I use the same beta as it is? Because their financial risk is different. So remove financial risk element. Remove financial risk of proxy. How do you remove? By applying debt equity ratio of proxy. By doing this, I get unlevered beta of proxy, which is equal to unlevered beta of KLM. Hope you understand. Their debt equity ratio is taken out. Financial risk is taken out. When you take out, what you get is the pure business risk, which proxy entity and KLM are in same line of business. So their financial risk will be same. Their unlevered beta will be same. Then you apply financial risk of your company, which is financial apply. Add means apply. Add means you literally add, you people. So apply financial risk of KLM. And how do you know financial risk of KLM? Which is same as debt equity ratio of ABC. And this process will give you levered beta of KLM. Ideally, I was not supposed to explain all these things. But knowing your nature for all these diseases, you have no idea. I'm sure you would not have remembered this, even a hint about the portfolio management. That too, I'm not explaining in detail. I tried my level best, beyond which I can't help. Okay, so levered beta of proxy entity. Equity beta means levered only. Keep it in mind. Equity beta does not mean unlevered. Of proxy entity 1.1. Okay, we want to calculate unlevered beta. How do we calculate unlevered beta? It's calculated by levered beta divided by 1 plus debt by equity into 1 minus T. This way, debt equity ratio is being removed, which is 1.1 divided by 1 plus debt by equity. Which company's debt by equity should I apply? The proxy entity debt equity ratio. Proxy entity debt equity ratio is 1:4. So 1/4. 1/4. Tax rate 30%. Corporate tax 30%. 1 minus 0.3. So this will give me 0.93617. 0.9362. Okay, this will tell me the unlevered beta. Now from this unlevered beta, apply debt equity ratio of KLM, which is same as ABC. Debt equity ratio of ABC happens to be 1:3. Apply 1:3. Levered beta is calculated by unlevered beta into 1 plus debt by equity into 1 minus T. So 0.9362 what we got now into 1 plus debt equity ratio of ABC 1:3, 1/3 into 1 minus tax rate 1 minus 0.3. $1.1546, I think. Okay, 1.1546. Okay, so this is what ultimate levered beta of KLM we wanted to achieve. If you remember that shortcut I told you, LUL, that is start from levered, go to unlevered, go to levered again, LUL. Anyway, so let's calculate the cost of equity as per CAPM. RF plus RM minus RF multiplied by beta. Risk-free rate is given to be risk-free rate is 4, market rate 10. So 4 plus 10 minus 4, RM plus RM minus 4 into 0.9362. And please, for God's sake, don't do directly in calculator. Calculate second part first, then add 4. 10 minus 4 into 0.9362 plus 4. So not 0.9362, 1.1546. Not 0.9362, 1.1546. 1.1546. 10.927. No, 10.93. 10.93. Okay, so first part of the question we have done. Let's go for second part of the question. A range of values for KLM before and after. Now, valuation normally we used to do based on either P ratio method or dividend valuation method. But in this problem, we have dividend also, P ratio also. So, which one shall we do? Let's do both. Why both? Because they said range of values. They have not asked one particular thing. So let's do valuation based on dividend payout ratio also. Let's do it based on P ratio also. Both information is available. Let's do it on both. And they've asked for range of values. One interesting important point. Which P ratio will you apply? The acquirer P ratio will you apply? The target P ratio will you apply? or the proxy entity P ratio will apply. XYZ, the acquirer, ABC, the present holding company, proxy entity in the same line of business, which P ratio to be applicable? Same question, which dividend payout ratio will be applicable? The answer is multiple. What do you mean by that? Different people can argue different ratio applicable. All the three are equally logical. How, sir? XYZ is the acquirer. So after acquisition, they become part of your company. So your P ratio will be applicable to their ratio also. That's what we have been doing the problem so far. The acquirer ratio, a P ratio assumed to be same, and we have seen how the profit is going to happen because of that. That is definitely valid. Sir, can I say proxy entity P ratio? Also fine, because what is P ratio? P ratio is the confidence level of investor. So whatever confidence level of investor having in proxy entity, because they are into that line of business, we can say similar line applicable here. For example, P ratio in Infosys and TCS will be very similar because they are both are software companies. We can't compare P ratio of Tata Chemicals. We can't compare P ratio of ITC because they are into different business. So that logical also is there. Or you can also say currently KLM is under ABC. ABC is holding company. Under them, KLM is there. Reliance is holding company. Under that, one more subsidiary is there. So whatever P ratio applicable for holding company applies for their subsidiary also. You can have that logic. So you can't limit yourself by one or two. So because in the problem they said all the ranges, I'm applying all values. But in the exam, you can limit yourself for one or two depending on whatever interpretation you want to write. Okay, so let's write the problem in a columnar format. So let me do using P ratio method, using XYZ P ratio, using proxy entity P ratio, using ABC P ratio, using XYZ, the acquirer, using proxy, similar business, using ABC, the current holding company. Everything is logical. Of course, depends on which you want to convince more and which is more influential. Okay. So using synergy value, using a ratio, 10 is the XYZ P ratio, 12 is the proxy limit P ratio, 13 is the ABC P ratio. Apply all, you get 100, 120, and 130. They are asking post synergy also. They want pre-post. And they said the synergy benefit is 10%. So 10 crore is the current profit. Synergy benefit 10% more. So 1.1. So 1.1 means 1 plus 0.1 and 0.1 is the 10% synergy benefits. Same thing in second also. Same thing in third also. So you get 110 crore, 132 crores, 143 crores. Please write down. Okay. Okay. This is using P ratio. We can also using dividend discount model and same logic applies. So which dividend payout ratio to be applied, sir? You can say going forward they'll be part of XYZ, so their payout ratio applicable. Or water proxy entity, you also follow similar policy, you can say. Or using ABC current holding company, because water holding company says subsidiary has to follow. So payout ratio of acquirer may be applied, payout ratio of proxy entity may be applied, payout ratio of ABC may be applied, the current holding company. In the exam, you need not write all the three columns. You can mention one column also fine, or two columns is also fine. And say alternatively, other things can be considered. In the exam, you not write all the things. But here we are discussing concepts, so I'm writing all the three possibilities. In the exam also, if you can write all the three, it's fine. But exam time constraint might be there. So 1 or 2 if you write column sufficient. Okay. Using XYZ payout ratio, using proxy payout ratio, using ABC payout ratio. So earnings 10 crores, growth rate 7%, 7% growth rate. Here also 10 crores earnings, 7% growth rate, 10 crore earnings, 7% growth rate, and 40% payout in XYZ, 50% payout in proxy, and 50% payout in ABC. By K minus G, K we calculated cost of equity as per CAPM, 10.93% KE, and this is growth rate 7%. That's same for all the three. This is 108, 136, 136, and this is pre-synergy. Post-synergy means this 10 crore will increase by 10% more. It becomes 11 crores. This 1%, 0.1 represents synergy benefits. Everywhere. 10 crore into 1.1, 10 crore into 1.1 divided by K minus G. So you get the post-synergy value. And they've asked for the range. So minimum is 100 crores. Maximum is 149 crores. So you can just mention range of values, maybe anything from 100 crores to 149.75 crores. Okay. If time is already over, you can take a quick screenshot of this one and you can copy it down later. So basic concept, how you apply, hope you apply. They've asked for pre-synergy, post-synergy. That's why so many calculations are coming. And P ratio method also there, dividend discount method also there. So we are doing under both the methods and using the current holding company ABC or the acquirer XYZ or the proxy entity ratio. Anybody ratio can be applied. All are logical. We have applied all the 3% P ratio, all the 3% dividend payout ratio. So many valuations. That's the nature of valuation. It's subjective in nature. Okay, so again, if you are finding time short to write down, please take a screenshot and copy it down later. Okay, so moving on with respect to the problems on mergers, please come to this problem. The CEO of a company thinks that problem. Hope you got the problem. Let us do this. Let us do this. CEO of a company thinks that shareholders always look for EPS. Therefore, he considers the maximization of EPS as his company's objective. So, basically, when we talk about post-merger, what to be maintained, here we will make sure post-merger EPS should be maintained. His company's current profits are 80 lakhs, P multiple of 10.5. He wants to buy another firm which has a current income of 15.75 lakhs and a P multiple of 10. What is the maximum exchange ratio which CEO should offer so that he could keep the EPS at current level, given that current market price of both the acquirer and the target company are 42 and 105 respectively. What is the maximum exchange ratio CEO should offer so that he could keep the EPS at current level? So effectively, can we say the exchange ratio should be based on EPS itself? We can directly say that, but we can't write the one line answer in exam. We should show the calculations. So we will use that as a verification. We'll use the EPS based exchange ratio as a verification. If the CEO borrow funds at 15% and buys out, he borrow funds and buys out. It's like a levered borrowing. He is taking loan and then is purchasing the company. buys out the target company by paying cash. How much he should offer to maintain his EPS? Assume tax rate of 30%. Okay, let's calculate the first one. Okay, let's quickly write down the acquirer information, target company. We need number of shares typically. Have they given number of shares? Not given. Okay, they've given profits after tax, PAT of 80 lakhs here and 15.75. 15 lakh 75,000 is given. Then income, okay, PAT, okay, P multiple of 10.5, P multiple of 10.5 and 10, and market price also given 42,105. Now when market price and P ratio available, you can calculate EPS, right? You can calculate EPS. How to calculate EPS? Market price per share divided by P ratio. So 42 divided by 10.5, which is 4 rupees, I think. And 105 rupees market price divided by P ratio, which is 10.5, I think. And number of shares we can calculate because we know PAT and we know EPS. PAT 80 lakhs, EPS is 4. So number of shares you can calculate. PAT divided by EPS, that is 20 lakh, is the number of shares for acquirer. And here how much you get? 15 lakh 75,000 divided by 10.5. So how much you get? One lakh 50,000 shares. 1,50,000 shares. Okay. So what is the requirement? They said first part of the question, to maintain EPS. What is the maximum exchange ratio? For acquirer. So when we have to make sure that the EPS will be maintained, so we'll simply write EPS before merger will be same as EPS after merger. This is for acquirer because we are doing for acquirer. If you're doing for acquiring, I mean, if you're doing for target, what you would have done? EPS after merger multiplied by swap ratio you would have done because it has to be comparable. Equivalent EPS you would have considered. EPS before merger for acquirer, we have calculated 4 rupees. EPS after merger, earnings of the merged entity will be 80 lakhs plus 15 lakh 75 plus 0 because if any synergy benefit is there for that, whole divided by the existing number of shares, which is 20 lakh plus the number of shares issued, and that depends on the number of shares of target company 1,50,000 and multiplied by the swap ratio R. Let's cross multiply. 20 lakh into 4, 80 lakh. 4 into 1 lakh 50,000, 6 lakh. 4 into R, 4R. 80 lakh plus 15 lakh, 75, 95 lakh. 75,000. So 4R equals 95 lakh 75,000 minus 80 lakhs minus 6 lakhs. So for R, 9 lakh 75,000. Wrong. 6R, sorry, you get. Yeah, correct. 6 lakh, 6 lakh R. 4, correct, it's fine. 6 lakh. Oh, not per, sorry, I did wrong calculation. This is not plus. This is not plus. 4 into 1 lakh 50,000 will give you 6 lakh R. 4 into 1 lakh 50,000. You get 6 lakh R. Directly you get, not 6 lakh and R separately. This into is there, no, not plus. I read as plus, sorry. So 4 lakh into 1 lakh 50,000 will give you 6 lakh R. And 80 lakh goes to right side, that becomes minus. And here we say 6 lakh R. 95 lakh 85,000 minus 80 lakh, which is 50 lakh 75,000, divided by 6 lakh. Lakh 75 by 6 lakh, it's 2.625. It's to 1. So for every 1 shares, you have to issue 2.625. It makes sense because EPS of the acquirer is less, only 4 rupees. EPS of the target is more. Alternatively, I told you, you can simply calculate this by exchange ratio based on EPS. Exchange ratio based on EPS. If you calculate like that, the exchange ratio of an acquirer is, target is 10.5 and divide by acquirer 4, and you would have got 10.5 by 4, 2.625. How come we got simple answer like this? Because there was no exchange ratio. There was no synergy benefits. It matched because of no synergy. It matched because of no synergy. No synergy. In the exam, keep it in mind. If they ask you like this, to maintain EPS, you have to show all these calculations. You can keep it in mind method because the answer will match because of exchange ratio being same in the sense based on EPS exchange ratio. You can use it in your mind, but for presentation in the answer in exam, please write full calculation because in some problem there might be synergy benefits. Okay, let me go for second part. Okay. If the CEO borrow funds at 15% and buys out the target company by paying cash, if CEO borrow funds, if acquisition is funded by borrowings, it's called as levered buyout. If acquisition is funded by borrowings, if acquisition is funded by borrowings, then how would you handle it? Again, objective is say maintaining EPS. Therefore, EPS before merger should be equal to EPS after merger. Equal to EPS after merger. EPS before merger, we calculate by, we given 4 rupees, that should remain same. And EPS after merger, we are going to calculate similarly 80 lakh acquire company profits plus 15 lakh 75,000 target company profits plus 0 if any synergy benefits minus the interest cost. Interest cost, how do you take? Loan amount, what you take, multiplied by rate of interest. How much is rate of interest? 15%. Borrow funds at 15% into 15%. And one more adjustment to be done on this one. We have 80 lakh, 15 lakh, 75,000, which are PAT, after tax. So interest also should be after tax. So you multiply it by 1 minus tax rate if available. They have given tax rate given 30%, which is 1 minus 0.3. The interest portion. This one, we are talking about interest portion. Whole divided by number of shares. Existing 20 lakh plus issued how many shares? In this case, what we have to calculate? How many shares are there? What we should take? How many shares are to be issued? What we should take? Okay, I will tell you. Knowing you for these many days, I don't expect you to give any answer and not a right answer. It is by borrowings. It is by issuing cash, not by issuing shares. Therefore, here no shares are issued. 0. It is PC paid in cash, not by issuing shares. So no exchange ratio applicable. No shares issued. Entire purchase consideration is paid by cash. So let's cross multiply. 4 into 20 lakh, you get 80 lakh. You get 80 lakh plus 15 lakh 75, 95 lakh 75 minus loan into 0.5. This is 1.7. 0.7 into 0.1 for 15% means 0.15 into 0.7. 0.105. 0.105 loan. Okay, this come left side. 0.105 loan is 95 lakh 75,000 minus 80 lakhs. That will give you 15 lakh 75,000. So loan amount 15,75,000 divided by 0.105. 1 crore 50 lakhs. 1 crore 50 lakhs. Okay. So what is the interpretation of this? This is the maximum PC, maximum amount that can be paid. Maximum amount of loan that can be taken to pay out, to pay purchase consideration, to acquire the company. If they take more loan than this, they end up in more interest cost, EPS will be affected. If they end up in taking less loan than this, then EPS will increase, earnings will increase because interest cost will be less, EPS will be increased. Positive impact will be there. So if you take a lesser loan, interest cost will be less, earnings will be more, EPS also will be more. This is the cutoff point, maximum point. Just like in shares. So first part of the question, settlement by way of shares. Second part of the problem, settlement by way of cash. So both of them in single problem. So when you talk about settlement by way of shares, we talk about maximum exchange ratio. If you talk about settlement by way of cash, then you are talking about this calculations. If you use own cash, interest cost will not be there, but you should keep it in mind the opportunity cost, because those cash, had you used elsewhere, how much return you would have generated, so that would be considered. But for the impact on the EPS as such, it will not be there because it will not have any actual interest costs. If you use own cash, interest cost will not come. But conceptually, when we're discussing, when we are having negotiations, we will not say it is interest free. For calculation in practical life, I'm telling, for examination purpose, if you don't take loan, you don't take interest. When we talk about opportunity cost itself is after tax, always when we take, like required rate of return. So we don't have to do 1 minus t and all there, because when we say opportunity cost, cost of debt, cost of equity, overall cost of capital, WACC, everything is after tax. So again, no need to do any 1 minus tax rate in that case. Okay. This is one part. I would just like to explain one more related for this problem only. Effectively, what is really happening? If you consider a typical merger, what happens in case of acquirer and case of target? What does target will transfer to acquirer, and what does acquirer will pay to target? If you consider in terms of your accounting, what the acquirer receive is called as net assets, and what target receives is called as purchase consideration. Correct? Now again, here what is happening, here, because we are talking about earnings, the same flows I will express in terms of earnings. Acquirer and target. Okay, what does acquirer gets from the target is the earnings. I'm talking in earning terms. That's why I'm rewriting this chart. Earnings of target. And what does acquirer pay? He does not pay them directly. I mean, in terms of cost, they pay purchase consideration. He takes loan and purchase consideration, but he paid to outsiders. He paid to outsiders, others. He's taking loan, right? Therefore, he's paying interest costs, interest on loan. Hope you are able to understand from the acquirer point of view what is the cost that is happening to the acquirer, what is the benefit that is happening to the acquirer. Benefit for the acquirer is he is receiving earnings from the target company. Cost for the acquirer is he is taking loan and paying interest. On that loan, your interest cost becomes your cost of merger in this case, because you're paying interest and then paying the money. You're taking loan and paying interest. So interest will be cost for the acquirer, and the benefit what we get is earnings. So basically here they are telling in which situation his profit and his net profit will be zero. His cost will be equal to benefit. So if you simply compare, his cost should be equal to benefit. Of course, in some problem, it might be some synergy also, not just earnings. You also might get savings. Synergy also you might get there. In this case, what is the benefit you're receiving? The earnings of the merged entity, 15,75,000. And what is the loan amount? I mean, cost you're paying, loan amount. On that, you're paying 10.5% interest. And after tax, 1 minus 0.3. So basically, your loan amount should be 15,75,000 divided by, I think this will become, this is 15%, no? 15% into 1 minus 0.3. So 15,75,000 divided by 15% divided by 10.5%. You get answer 1 crore 50 lakhs. So maximum loan that can be taken, maximum amount that can be paid, maximum interest that can be paid. So basically at what point your cost and benefit will be equal, no profit, no loss, indifference point. That is, if you take a loan of 1 crore 50 lakh and pay the money. If you take more loan, your cost will be more, interest cost will be more. So cost exceeds benefits, that's not benefited. If you take below 1 crore 50 lakh, then your interest cost will be less, benefit will be more, the merger will be more attractive in terms of maintaining EPS is concerned. So that's the analysis. I just want to keep it to you. So in fact, if you want to directly calculate, you can do for verification purpose. Don't do it for presentation purpose. Okay. So hope you got it. Okay. Let me go further. Okay. So now let us do this one problem on bank merger, which has been asked in the exam recent times, 2-3 attempts back, but they have been asking repeatedly because presently we are seeing this lot of these situations for various reasons. Sometimes government decides that PSU bank should be merged, and sometimes they think, some other banks like Yes Banks and Lakshmi Vilas banks are going bankrupt and they need to be merged. Yes Bank is not merged, but situations because of banks facing problems, bank merger is what many people's solution is. So exam is also, they're concentrating on this one. XML Bank was established in 2001 and doing the banking business in India. The bank is facing very critical situation. There are problems of gross NPA at 40%, CAR, CRIR, capital adequacy ratio, capital risk weighted asset ratio, at 2%. The net worth of a bank is not good. Shares are not traded regularly. Last week, it was traded at 4 per share. RBI audit suggested that the bank has either to liquidate or merge with other bank. I think typical Indian solution. If you have a problem in life, either die or get married. Both are same here. ZML Bank is professionally managed bank with low gross NPA of 5%. It has net NPA of 0% and CAR of 16%. Its share is quoted in the market at 64 per share. The board of directors of ZML Bank has submitted a proposal to RBI for takeover of the bank of XML on the basis of the exchange ratio. Balance sheet given, liabilities, paid up capital, reserves, other liabilities, etc. It was decided to issue the shares at book value of ZML Bank to the shareholders of XML Bank. All asset liabilities are to be taken over at book value. For the swap ratio, weights assigned to different parameters are as follows: gross NPA, CAR, market price, book value. You require to calculate the swap ratio based on the above rates, calculate number of shares to be issued, prepare balance sheet after merger, and compute CAR and gross NPA after merger. In the example, in this exam problem, this last question was not asked. But in the one more exam question, this last question was asked. So I am adding here also. So you understand how to do calculation of this one. Okay. So here we are talking about bank merger requirement based on swap ratio. Let's focus on that first. Swap ratio, regular formula, tau, target by acquirer. So we have these ratios to apply. So normal formula is fine, target divided by acquirer. But as I told you, when the ratio is reverse, in situations, the ratio lower the better. Debt equity ratio lower the better. Inventory days lower the better. Trade receivables lower the better. Bad debt ratio lower the better. You should know which are the ratio lower the better. Again, IPCC, that and all I can't do it here now. I know you don't have time to go back, but that much I cannot recollect. That is too much at this stage to cover. So basically, based on my interaction so far, what I understand is your expectation is you want me to do what you have done in the past, that is your previous life IPCC foundation, and you want to learn, or you want me to teach what you're doing at this level, that is what is required for exams, and you also want me to teach what is applicable for practical life. So you want previous life to be taught, current life to be taught, your future life also to be taught, and within the short time whatever we have. Anyway, amazing. So these ratios, many ratios of course, are lower the better. When the ratios are lower the better, the swap ratio formula will get inversed. In this case, gross NPA, that is NPA, it sounds like combination of NDA and UPA. I hope you understand. Combination of them is called as non-performing. Both are non-performing. So non-performing asset is like bad debts, and a higher non-performing assets should not be awarded with a higher number of shares. If you have a gross NPA being higher, you should be penalized. You should give a less number of shares, not more number of shares. It's not target by acquirer, it becomes acquirer by target for gross NPA. For market price, we have been seeing so far, higher the better, normal ratio. Book value, higher the better, normal ratio, we don't touch it. What about CAR? I don't know whether you know the full formula. Capital adequacy ratio. I'm sure many people would have left these things in intermediate for choice. You can leave it here also for choice. You can leave the exam also for choice. Capital adequacy ratio. Capital adequacy ratio means for some amount of loan given, how much capital backup you have. For every 100 rupee loan given, how much capital backup you have. So 10% means with 100 for 10 rupee capital, 100 rupee loan you have given. For every 100 rupee loan, how much capital base you have? Capital adequacy ratio, risk weighted capital assets. You would have had, I don't know whether you remember, Tier 1 capital fund, Tier 2 capital fund, Tier 3 capital fund, Tier 4 capital fund, and all was not there. Only two tier was there, Tier 1, Tier 2. Anyway, but the bottom line is capital adequacy ratio represents the capital maintained by the bank. Higher the capital they maintain, safer is the bank. So all the three ratios are higher the better. We are not going to teach the basic format. Only the gross NPA, which is the ratio, lower the better. So their formula needs to be reversed. Okay. So here let's calculate swap ratio first. Let's go in the order in which they have given. Based on NPA, gross NPA, the swap ratio, weights is 40. This is weight. 0.4, then the product. Okay, let me just fill up this. We have car market price, and also book value. Weights given 40, 10%, so 0.1, 40, 10, 0.4, 0.1. Okay. Now, gross NPA, let's calculate. Gross NPA of XML, and the bank is very critical situation. Gross NPA at 40%. Target company gross NPA 40%. Acquire target company NPA gross NPA 40%, and CR 2%. ZML Bank is a professionally managed one, and they are having a gross NPA of 5% and CAR at 16%. Okay, so they have gross NPA of 5 and here 40. And if you are a little bit smart enough, you can also make out which higher the better, lower the better. Because when a company is facing problems, they will always have worse ratios. Higher is also worse, meaning higher the when they have a higher ratio, it's bad. If they have lower ratio, lower the bad. So based on the ratio of the worst bank, you can make out whether that was good or bad. Anyway, that is the little bit if you're smart, but that depends on how you think. Anyway, don't ask me to explain that. That is not part of this objective here. Okay, so 40% is the gross NPA, and here gross NPA is 5%. So it was supposed to be 40 by 5, but here we'll make it as 5 by 40. It's an exception because this is ratio inversed. So acquirer by target. You get 0.125. CAR is 2 and 16. So 2 by 16. This is 0.125. Market price. This is trading at 4 per share and he's trading at 64 per share. So 4 divided by 64, I think 0.0625. Okay. Okay. Let's come to last one, book value. Book value part. That will be available from the balance sheet. They have assets minus liabilities you can do, or you can do paid up capital plus reserves and surplus. Both are fine because there are no any changes to be done. XML Bank is the target. So they're given target company first, and ZML Bank is the acquirer. So 70 plus 35. The book value 70 plus 35. I may just do a small calculation below. Book value per share for the acquirer. I mean, for first one is target 70 plus 35. Car is 4 by 60, na? 2, right? Capital equity ratio 2 and 16. 2 by 16, right? That's what my material says. It's 2, right? Capital equity ratio. Why 4 by 16? 2 and 16. I don't know how 4. Maybe in your material it's printed like that, maybe 4. I'm not sure. Okay. Okay. So book value per share 70 plus 35 divided by number of shares. Paid up capital 70 by 10, 7 crores divided by 7. 15. And here 250 and 2750. 250 and 2750. Since no changes are there, I'm using liability method. Share capital plus reserve surplus also net worth. I'm doing that method. Or you can do assets minus liabilities. That's also fine. Divided by number of shares, 250 by 10, 25 crores. 250 plus 2750 divided by 25, 120 per share. So target company 15 divided by the acquirer company 120. So 15 by 120, 0.125. Okay, let's multiply the products. 0.125 into 4 into 0.4, 0.05. 0.125 into 0.1, 0.0125. 0.0625 into 4.4, 0.025. 0.125 into 1 into 0.1, 0.0125. Total 0.1. 0.1 is to 1. So swap ratio, this is 0.1 is to 1. The number of shares to be issued. Number of shares to be issued. For every 1 share, you issue 0.1 share. And how many shares does XML Bank has? 7 crore shares. So 7 crore shares multiplied by 0.1 means you get 0.7 crore shares or 70 lakhs shares. to be issued. 0.77 crore shares or 0.70 lakh shares. Okay. Now, they also asked us to prepare the balance sheet after the merger. So, since balance sheet after the merger, we have to prepare a quick accounting concept. You need to keep it in mind, because when the company issues shares and what they get, so what they issue, it's called as purchase consideration, and what they get is called as net assets. So, acquirer, what he gives is purchase consideration, and what he gets is net assets taken over. In your Ind AS terms, it's called as net identifiable assets. The difference, what do we call it? Difference between the amount what they pay and what they receive. The difference is called as either goodwill or capital reserve. Depends on what is the amount, and we don't say capital reserve in Ind AS 103. They say gain on bargain purchase, and in some cases they also call it as capital reserve. So both of them thing exist, and it's one of the carve out in Ind AS 103 also. Anyway, that is not part of our discussion now. Now, how much net assets he is getting, that we know very clearly. Net assets, what he is getting is the book value 70 plus 35, because no fair value changes are there. So net assets, what is coming in is 105. Net identifiable assets, net assets taken over 105. 70 plus 35, share capital plus reserve plus asset minus liability, all same thing only. But what they're issuing is 70 lakh shares, 0.7 crore lakh shares. So 0.7 crore shares, at what price they're issuing? This institute solution, my interpretation differs slightly. Institute solution says it is issued at face value, but my interpretation says, since they said it was decided to issue the shares at book value, this is a sentence, issue the shares at book value. Since they mentioned the word book value, I would take book value per share. That is my interpretation. But institute has taken in their solution share capital, face value. Whichever you want to present, you can go. But I would recommend, since the question said issue shares at book value, I will go for it. And what institute has done also, I told you, whichever is comfortable, convenient, you follow it. Issue shares at book value, and book value of the target company is happened to be 120 per share. So 0.7 crores into 120. That means you are paying 84. That's my interpretation. If you take face value, 0.7 into 10, it becomes only 7 crores. So remaining 98 becomes capital reserve. But in my example, in my calculation, balance 21 becomes capital reserve, because net assets taken over 105 is higher, payment 84 is less. Since the taken over is more, you will have a capital reserve of 21. Difference 105 minus 84. 21. This is my interpretation. I'm doing it. If you want to go with institute solution, as I told you, please go with face value, which is they have taken. I don't really find the reason specifically why they have taken, but they have taken that solution. So the choice is in your hands, whichever you want to present. Okay, so let's go for balance sheet after merger. Balance sheet of merged bank. Balance sheet of merged bank. Okay, everything line by line item. Let's start with share capital. Paid up share capital. This you should be little careful. Existing share capital was 250 crores plus what they've issued. You can see here zero point 0.7 crores, face value 10 rupees, so 7 crores. 0.7 issued multiplied by 10. So total becomes 257. Reserves and surplus, existing 2750. Reserves and surplus, existing was 2750 plus capital reserve. We calculated 21 plus security premium because issued at book value, issued at 120 rupees, face value 10 rupees. So 0 0.7 crores into 110 rupees. 0 0.7 crores into 110 rupees. 77. If you take it at face value, then together it would have become capital reserve of 98. But here we are breaking it down. Overall same 2750. The total 2848. Deposits 2000, 20,000. And don't ask me, sir, deposit, why is it coming liability side for a bank? Because you are capable of thinking like that. So I'm just clarifying it. Deposits, it is for a bank. For a bank, deposit is a liability. Okay. Next. Other liabilities 445 1250. 1695. That's all. Assets, cash in hand 200 1250. 1450. Balance with other banks, thousands. 0 plus 1000, thousands. Investments 550, 7500. 8050. Advances 1750, 13500. 15 to 50. Uh, Other assets 50 and thousands. 1050 total. 26,800. Okay, you want the cap reserve calculation as expected. So you want to go to IPC level and fund level also you had this, but anyway. So 0.7 crores is the shares issued, book value per share 120 per share, so 84, and net has taken over 105. You take over 105, but you issue only 84. You received more, you paid less. That excess is called as capital reserve, or formula wise we say purchase consideration minus net assets. If positive it's goodwill, if negative it's capital reserve. And how 0.7 crores? Number of shares to be issued. How 120? Issued at book value, which is I have taken. At institute taken, they have taken it at face value 10 rupees. So they would have taken 7 crores. We have taken 84 SPC value. And therefore for us, 21 capital reserve came, 105 minus 84, for them 98k. For us, the balance number will come by way of security premium. 110 rupees into 0.7, it is 77. So 77 we are showing as security premium, 21 we are showing as capital reserve. In institute solution directly they are showing 98 itself as capital reserve. Okay, I'll go further. Compute the CAR and gross NPA after merger. Now CAR, how to calculate CAR, capital adequacy ratio? We will do capital funds divided by risk weighted assets. But here capital funds by risk weighted assets, the risk weighted assets, I don't know whether really do even talk about it, that whether you remember it. Cash in hand balance will have 0% weight, balance with other banks will have 20% weight, investments will have loans advance guaranteed by government and others. So those kind of risk weighted calculations are there, but will not go behind it because we really don't know the information. So what do? We'll work backwards. That's what Institute also done in the other problem. Let's apply the same concept here. So after merger, let me just quickly show it to you. Like what was situation of do we consider even debt equity ratio? I really don't know which language to cover. I explained at the beginning. I earlier also have explained it. Any ratio which is higher the ratio, not comfortable. Lower the ratio, the better it is. In that ratio, if we use for swap ratio calculation, then the formula need to be reversed. The list of ratios which are lower the better are debt equity ratio, debt ratio. Debt equity ratio is debt by equity. Debt ratio is debt by debt plus equity. Inventory days. calculated by average inventory divided by cost of goods sold into 365, or can also be calculated by the cost of goods sold divided by inventory turnover ratio. So average raw material held, average WIP held, average finished goods held, average receivable days, average payable days, uh, debt equity ratio. So these are the ratios. Even we can say certain capital gearing ratio we have. So these are cost of goods sold. We have operating expense ratio. So so many ratios are there which are lower the better. Lower is found to be more comfortable than the higher. So if that is the case, if swap ratio is determined based on any ratio which is lower the better, then the swap ratio will be reversed. It will not be target by acquirer, it will be acquirer by target. The logic behind that is we want to not encourage people having bad ratios. If you apply the formula of uh, target by acquirer, if target had a bad ratio, higher ratio, they end up in getting more number of shares. They should not get more number of shares. Therefore, we need to reverse it. And that is why we are doing inverse. This problem happened to be bank merger. But the concept I'm explaining is in general, right? Am I telling so far it is only for bank merger problems? If it was only for bank merger problems, I would have told one sentence, it's for bank merger over. Why was the need for me to explain the full logic of explaining the ratios reverse, when it will be considered, what are the other ratios possible? So wherever you consider the ratios, lower the better. Whichever ratio you calculate, whichever problem you calculate, whichever part of the world you are in, concept is same, that when the ratio is lower the better, the formula for swap ratio will be inversed. Will be inversed. It can be even cost of capital. Cost of capital also will be similar. Again, we can give many examples like that. Okay. So let's calculate the ratios after the merger. So we were having XML bank, ZML bank. Then merged entity. And what they have given, CAR before merger were, we calculate also 2%, 16%, 16% 2% for the XML and 16% for ZML. We want merged entity how much after merger? What do you mean by the word 2%? The 2% represents for every 2 rupee capital for 100 rupee advances, 100 rupee assets, investments, loans, 100 rupee loan, capital adequacy ratio, 100 rupee loan. Similarly, 16 by 100 means 16 rupee capital for every 100 rupee loan. The risk weighted, not just loan, the risk weighted assets. Let me just write it. Risk weighted assets. Risk weighted assets. Now, we are not in a position to calculate risk weighted assets because we really don't know, because the percentages are different in different situations for different categories. But capital normally we can calculate. Capital is nothing but their shareholders' funds. Share capital plus reserves and surplus. So how much was the amount of capital before mergers? Share capital plus reserve surplus, both of them. 70 plus 35, 105. 250 plus 2750, 3000. 105 and 3000. So capital is 105 and here the capital is 3000. Merged entity will come later at the end. So we can do percentage basis. If 2 rupee represents 105, how much for 100? We can simply cross multiply. 3000 represents 16%, how much for 100? We can do cross multiplication. It is nothing but 105 into 100 divided by 2 is as good as 105 divided by 2%. And here 3000 divided by 16%. In the sense, 2% is 105. What do you mean by 2%? For 100 rupee risk-weighted asset, 2 rupees is the capital. So 2% represents 105. 16% represents 3000. If 2% itself is 105, how much is 100%? If 16% itself is 3000, how much is original 100%? So 100 by 2%, 3000 by 16%, you get 5250 is risk weighted assets. $18,750. So in the merged entity, total 24,000. Capital fund in the merged entity, as per balance sheet we prepared, paid up capital 257, reserve surplus 2848. 257 plus 2848. 3105. So merged entity calculation CAR will be the capital fund by assets into 100. Capital fund 305 by risk weighted assets 24,000 into 100. 1.27%. No, not 1.27, 12 something. 3105. Okay. 3105. 3105 divided by 24,000. 12.94, 12.9375. 12.9375%. So you can see one was 2%, other was 16%. So when you mix both of them, it become an average 12.9375. Hope you understood what we calculated. 105 is the capital fund, represents 2%. 2% means for 100 rupees assets, 2% capital. So we have capital of 105, which represents only 2%. So original assets should be how much? We divide by 2%. Similarly for ZML Bank. 16% is 3000. 16% is capital. How much the original assets? Okay. Then for computing NPA is not at all a problem. That's very simple one. NPA, XML Bank, ZML Bank, merged entity. We had advance because NPA is applicable on advance from the asset side. Advances we had 1750, 13,500. 1750, 13,500. On this, you can apply the NPA percentage, gross NPA percentage. and that will give you gross NPA in rupees amounts. So NPA percentages, gross NPA percentages are 40% and 5%. You can multiply it by 40%, you can multiply it by 5%. 700, 675. Total you can calculate merged entity 600 plus 700, 675 plus 700, 1375, and 1750 and 13500, 15250. So what is the ratio we have to calculate? 1350, that is the gross NPA, by 15250 advances into 100. One three seven five you get. Okay. 1375. 1375 by 15 to 50 into 100. 9.016, 9.02%. So again, logically you can see it was 40% one company, 5% other company. When you mixed it, average 9.02 came. So merger is also like a portfolio only. So 40 of one company, 5 of another company. When they came together, a portfolio happened, average happened, you get 9.03. It's not a simple average, it's a weighted average. Net NPA, here they have not used it, so it's not relevant. Okay.